Unlocking the 401k vault, what really happens when you take the money out. Welcome back to our ongoing series on 401k plans, where we take a detailed yet human approach to the processes and decisions that shape an employee's retirement future. In today's episode, we're diving deep into the next major chapter in the 401k journey, distributions from the plan. Whether it's a strategic rollover, a final payout at retirement, or an emergency withdrawal, understanding how money leaves the plan is just as important as how it got there. Let's walk through this together, not as a dry set of rules, but as the real-life options your participants face. Segment 1. Rollovers out, moving money without the tax hit. Picture this. An employee, Sarah, has just left the company after 25 years. She's not retiring yet, but she wants more control over her investments. What are her options? If Sarah doesn't want to cash out and take a tax hit, she can do a rollover. Rollovers allow participants to defer taxation by moving eligible account balances into another qualified plan or an IRA. There are two types of rollovers. Direct rollover. This is the cleanest and safest method. The check never touches the participant's hands. It's made out to the receiving institution for the benefit of FBO, the participant. No taxes are withheld and no penalties apply. Indirect rollover. Here, the check does go to the participant. Federal law requires that 20% of the taxable portion be withheld, even if the participant intends to redeposit it. Sarah then has 60 days to deposit the full amount, including the 20% withheld, which she must make up from her own funds, into a new plan or IRA. Otherwise, it's considered a distribution, and taxes and penalties apply. So the direct rollover is like a direct transfer from one vault to another, while an indirect rollover is more like taking the money home and racing the clock to redeposit it in time. Not everything in a 401k account can be rolled over. It's critical to know the rollover eligible items and those that are not. Eligible for rollover. Before tax contributions, Roth 401k into another Roth qualified plan or Roth IRA. After tax contributions with limitations, employer match and profit sharing contributions. Rollover money from previous plans, not eligible for rollover, required minimum distributions, RMDs. The IRS wants its tax revenue. Hardship withdrawals, installment payments over 10+ years, corrective distributions like refunding excess contributions, dividends on employer stock, payments to non-spousal alternate payees, usually from QDROs. Understanding this helps administrators answer one of the most common questions: can I roll this over? The answer depends not only on what's being distributed, but how. Let's imagine another participant, Carlos. He has a mixed 401k, some money is pre-tax, some is Roth 401k, and some is after-tax voluntary contributions. What happens when he rolls it over? Here's where it gets technical, but crucial. Rollover scenarios: before tax money, traditional IRA, no taxes now. Taxed when withdrawn before tax money, Roth IRA. Fully taxable at rollover, called a Roth conversion. Future growth could be tax-free if rules are met: Roth 401k, Roth IRA, no taxes at rollover. New 5-year clock starts again even if money was already qualified, unless the rollover is into another qualified employer plan and the original Roth start date is tracked after tax contributions. Traditional IRA or qualified plan, no taxes. Earnings continue to grow tax-deferred. Receiving plan must accept after-tax rollovers. Important tax tip for administrators: when Roth 401k balances are rolled over, the receiving plan must be informed of the Roth contribution start date and the tax basis versus earnings. This is necessary to determine whether distributions are qualified in the future. Let's say our participant, Mia, chooses not to roll over. She just wants to cash out her entire balance. Here's what happens. Taxable money. Subject to 20% mandatory federal withholding. State withholding may also apply. And if Mia is under age 59 and a half, a 10% early withdrawal penalty could apply, unless she qualifies for an exception, such as separating from service at age 55 or older. After-tax money, already taxed. No additional tax on the principal, but earnings on that money are taxable. Roth 401k. If Mia meets the qualified distribution criteria, age 59 and a half, 5-year clock, entire withdrawal is tax-free. If not, only her contributions are tax-free. Earnings are taxable. Let's wrap this section with a word of caution. Indirect rollovers are risky. If a participant like Kevin receives a check, he has 60 days to roll it over. But the plan already withheld 20%. So Kevin must add that 20% from his own pocket to complete the rollover without tax consequences. If he fails to do that, the withheld 20% becomes taxable. and Kevin may owe even more when he files. Moral of the story? Always recommend a direct rollover when possible. It's cleaner, faster, and doesn't tempt fate, or the IRS. And that brings us to the end of today's deep dive on taking distributions and rollovers from a 401k plan. These decisions can shape someone's financial future, so it's essential that plan administrators, advisors, and HR partners understand the rules, the risks, and the opportunities. Next time we'll explore minimum required distributions, beneficiary payouts, and the final journey of the 401k plan. Because the decisions don't end when a participant leaves the job. Until then, keep learning, stay sharp, and remember, retirement planning is not just about saving, it's about unlocking the right doors at the right time.